Something unprecedented just happened in China, and it flew completely under the radar. For the first time in history, the largest exchange-traded fund in the country isn't a broad market stock fund, it's a gold ETF. Here in the US, retail investors flock to the S&P 500 as the default wealth-building vehicle. China has an equivalent benchmark fund, but just recently a fund called the Guanyu Gold ETF dethroned it, pulling in $13 billion compared to the stock market's $12 billion. In the second largest economy on Earth, everyday citizens are now parking their wealth in precious metals. And it's not just retail investors. The People's Bank of China has been aggressively accumulating gold for 20 straight months, the longest unbroken buying streak on record since 2015. In June alone, they scooped up 15 tons, marking their largest monthly purchase since late 2023. In just the first 5 months of this year, China imported an estimated 700 tons, bringing their total imports to a staggering 14,000 tons since 2015. Global central banks are following suit from Poland to Kazakhstan. Institutions are hoarding metal. Starting July 24th, 4 of China's largest banks began shutting down retail paper gold trading to ensure citizens buy physical assets, not leverage paper used. This isn't just a story about China. US Treasury Secretary Scott Bessent published a revealing op-ed outlining a pivot toward Hamiltonian economics after personally visiting Fort Knox to verify roughly $1 trillion in gold reserves. Bessent laid out a blueprint that explains why central banks are hoarding metal and why some analysts believe gold needs to hit $38,000 per ounce to balance global trade. To understand why this matters, we have to rewind to 1791. Alexander Hamilton, America's first Treasury Secretary, presented a plan to Congress that would dictate US economic policy for the next 150 years. At the time, America was essentially an agricultural startup with virtually no manufacturing base. Hamilton argued that a nation dependent on foreign adversaries for its manufactured goods was still a colony in disguise. His solution was a two-part strategy: heavy tariffs on foreign imports and targeted subsidies for domestic infant industries. This protectionist approach transformed the US into the world's foremost industrial superpower. It's the historical playbook for empire building. Protect your domestic market, build your industrial base, and once you dominate, preach free trade to the rest of the world to prevent them from doing the same. But history shows that every empire eventually undoes itself through financialization. Britain embraced free trade in 1846, slowly de-industrialized, and by 1931 handed global supremacy to the United States. For the US, the turning point began in 1971 when we abandoned the gold standard. This triggered an era of financialization. Instead of making real things, America began shuffling paper. Corporations outsourced manufacturing to cut costs, relying on cheap foreign labor while engaging in massive stock buybacks to inflate their share prices. We traded our industrial base for cheap consumer goods. TVs and toys got cheaper, but essentials like housing, healthcare, and education skyrocketed. We hollowed out our economy, becoming incredibly wealthy on paper, but dangerously reliant on foreign nations for our survival. Now, the US wants to hit undo. Bessent's op-ed and recent speeches by US Trade Representative Jameson Greer signal a massive pivot back to Hamiltonian principles. The goal is to re-industrialize, protect Main Street, and project economic strength. But there's a fundamental problem. According to macro strategist Luke Groman, the US faces an impossible trilemma. You can only pick 2 of 3 goals: rebuild factories, protect Main Street from inflation, or maintain a strong overvalued dollar. If you want domestic manufacturing and low prices, the dollar must fall significantly to make US goods globally competitive. If you protect Main Street and keep the dollar strong, cheap imports will flood the market and factories will never return. If you want strong factories and a strong dollar, you have to implement massive tariffs, which guarantees runaway inflation. Bessent knows he has to sacrifice something, and that sacrifice will likely be the dollar. But an overt dollar devaluation would crash the global financial system. The solution is an escape valve. A neutral reserve asset that can absorb the dollar's devaluation without destroying the system would provide that escape valve. The only asset on Earth with a multi-millennia track record of doing this is gold, and China figured this out years ago. Back in 2009, in the ashes of the global financial crisis, China's central bank governor published a paper warning that the world's savings shouldn't be tied to one nation's fiat currency. He referenced John Maynard Keynes's 1944 proposal for the Bancor, a neutral commodity-backed international currency designed to automatically balance global trade. In 1944, the US rejected this idea because America was the world's manufacturing powerhouse, running massive surpluses. Today, the roles have reversed as the US is running deficits and suddenly Washington is echoing Keynes. Even former heads of the World Bank and IMF have suggested gold should anchor a new monetary system. They note that gold, while fixed in supply, has no ceiling on its price. So where does the $38,000 per ounce figure come from? It comes down to basic arithmetic based on trade surpluses and gold quantities. China's annual trade surplus sits around $1.2 trillion. Last year, they imported 940 tons of gold. If China were to settle that trade imbalance using physical gold, price per ounce would need to be roughly $38,000 to balance the math. At today's prices, there simply isn't enough gold to settle global trade imbalances. The evidence that this transition is underway is hiding in plain sight. Central banks are hoarding physical metal. China is shutting down paper gold markets. The US is exporting record amounts of non-monetary gold to China following high-level meetings last year. Groman outlines two possible endings to this macroeconomic saga. First, re-industrialization fails, the debt spiral continues, and the fiat system collapses violently, as in 1922 to 1945. In that scenario, gold skyrockets as people flee broken paper currencies. Second, the plan succeeds, and we see a managed transition to a gold-backed neutral reserve system. In both scenarios, gold wins. For investors, this points to a massive capital rotation away from financialized assets into tangible commodities. Since the first US-China trade war began in 2018, the S&P 500 looks great in dollar terms but is down 15% when priced in gold. Long-term treasuries have lost 78% of their value against gold. The illusion of dollar-denominated wealth is cracking. But this isn't a call to FOMO into gold tomorrow. A monetary transition of this magnitude will take a decade or more, and there will be brutal corrections along the way. I don't personally hold gold yet, but I am watching the macro environment closely for the right entry point. Understanding the endgame of this economic shift is crucial because the system is changing and winning assets will look very different over the next decade.